Good afternoon, everybody, and welcome to our webinar on More Beans, Cross-Selling for Profit. This is Tony Rizzo and Christine Zaccardi, and we're going to go ahead and get rolling, take the next 28.5 minutes, and go through how we can add more beans to your bottom line through effective cross-selling. So let's get started. Real simple. Cross-selling summed up in 3 words: sell more faster. That's all it is. And as we back off and, we could ask the typical, obligatory question, so what are the goals? And they could be something like increasing the customer experience as to provide maximum exposure to the brand and subsequently increase market share for core products as well as ancillary services. This will be accomplished through a convergent marketing strategy of mass messaging, social channel engagement, and community participation. Well, I'm hoping that that's really not your goals, and I want to get more specific than that. So let's boil it down to 3 things. No matter what size of institution you are, and there's some very large ones on the phone today, and there's some smaller ones on the phone. Business is about 3 things: increasing frequency, increasing the transaction volume, and growing new customers. That's it. So let's dig into those. Frequency. The thing here is I want you to get, as a customer, as a member, to buy more often. So you can base those on a number of triggers within your data. They can be things like, if we're talking about a loan, the date that the loan expires. The at-risk month, for example, if your auto loan churn is happening at about month 33, 34, then your at-risk month and the time to be cross-selling additional loans to get me to buy more often is probably in month 30 or 31. You could also cross-sell to get me to buy more often based on the existing balance. If it gets down to a certain level, we're selling more. Summed up, when we look at frequency, getting me to buy more often is about lifetime value, making me stick to you over a number of years as a customer, as a member. So that's part 1. Part 2, volume. I want you to buy more at the point of purchase. So things like cross-selling insurance. If you're sitting, I'm sitting at your desk and you've just booked a $35,000 vehicle loan, how can you turn that $35,000 loan into a $135,000 loan? Well, offering incentives to move loans while I'm sitting in front of you. One of the most effective ways to kind of guerrilla tactic-wise grow more loans. Incentive for auto pay. So all of those kind of things are going to sum up to really engage someone around volume and buying more at that point of purchase. Another way to think of that is share of wallet. So whether it's about lifetime value, share of wallet, increasing frequency, or volume, those are 2 of the goals that surround any marketing plan for really any institution. The third, new customers, new members, we're going to cover that next month pretty extensively in terms of ways we can do smart and intelligent prospecting beyond mass marketing. So there's my little plug for next month, and that's what we'll cover. So if we want to address our frequency and volume analytics, there's 3 ways we're going to do that to get to our goal of adding more beans to that bottom line: analysis, execution, and tracking. And with that, I'm going to work on my mouse skills and turn it over to Christine. And Christine, you should have control.
Great. Thanks, Tony. Well, analysis is key to getting those beans in the door. And from our analysis, our past analysis, we know that the average household out there is carrying 9 different financial products with about 5 different institutions. Now, that can vary from region to region, but it's been pretty consistent across the U.S. from what we've seen. Now, we also know that the average financial institution out there has 39% of its households that are carrying just one unique product with them. Now, based on those 2 facts alone, you can see the opportunity for growing your financial institution by cross-selling to just your current households. And I probably don't have to tell you that that 39% with just one product are not very engaged households and pose a very high threat of leaving your institution, which is all the better reason to really focus on doing something about it. And we can see that if we do something about it, as this chart here is showing us, we add just one product onto those single product household levels. If we increase that cross-sell just a little bit, we can more than double the tenure of them with us. And that number continues to go up with the number of products that we continue to add. So it makes sense, seems like a good idea, but it truly does take a commitment to making that happen, putting all those parts in place to drive a successful long-term program that really can create an impact. And on this next slide, I want to share with you the impact that one of my clients is experiencing. Now, this client has been committed to creating an ongoing, really meaningful, very targeted communication plan with its household, and it starts at the onset of that relationship and continues on. Now, they've been doing this for about the last 3 years. The chart that you're looking at here looks at the last couple of years, and what we're seeing here are the number of single-product households by the number of campaigns they received. And you can see the trend that people are less likely to be a single-product household the more campaigns they receive. And going on to the next chart, what you can see conversely is that those that are receiving more campaigns or more communications, getting more communications in front of them, are more likely to be those households with 4 or more products. So you can see the impact that something like that is having. Now, some of you might be thinking, that sounds like a great idea, makes a lot of sense, but maybe you feel like you don't have the budget to pull something like this off. Maybe the resources aren't there to compete with some of those really big banks that are vying for that same business that you are among your current households out there. And I can tell you in terms of marketing budgets, you're probably right. But and let me explain more. But as you can see from this slide, some of the larger banks that are out there, expenditures per account, and this is specific to credit card accounts, but they're willing to expend a lot of money on just securing one account from a college student, especially Chase here. I'd really like to see that ROI as a side note. Can't be a good one. But anyway, what you can see is that they've got a lot of resources, a lot of marketing dollars to put forth to acquiring new accounts. But my point here in showing you this is that based on the tools and the resources that you have available to you, and focusing in on the current households that you're serving, you have the ability to do a lot more for less money. And in fact, as you can see here at the bottom, marquee clients on average are spending $118 per new account. So much less than some of these big banks are putting forward. Now, most of that is with the current households out there, increasing that share of wallet among those current households. So what is it that they're doing? What's working for them? Well, we're going to get into that. Life stage information, utilizing life stage information to hone your product offer, hone the creative, do channel selection, looking at the next best product tool within the MCIF system that's available to understand what is that best product to put forth and make the most relevant offer. I want to talk a little bit about trigger-based approaches. Tony talked about a few examples early on. I want to get into some specifics and some of the successes we're seeing with some additional trigger-based approaches. And when we talk about trigger-based, right, what we're referring to are those are event or situation-driven marketing communications. Again, creating a meaningful, relevant communication with your current household. And then last but not least, looking at external data and the additional insight you can gain into what a customer's financial product needs are. So in terms of life stage, I want to talk about Cycle. And for those of you that aren't familiar with Cycle, what Cycle is it's a model that was built for financial marketers, and it helps predict product propensity. So we know what the best product to offer a household is. When you've got 39% of your household utilizing just one product for you, you lack some of that insight. And Cycle helps fill that blank in, lets you understand what might be the next most likely product to promote to them. With our clients, we're also using Cycle to develop creative and do channel selection, understanding where they're at, what life stage they're in, to really, again, create a compelling piece in a compelling way. Now, Cycle can be combined with the next best product tool in Marquee, in Marquee's MCIF system. And the next best product tool, it's a great tool that's out there. It's built based on some complex algorithms that help predict what that next best product is. And then additionally, we can bring in fields such as cycle to help further predict that. And I thought it would be interesting to share an example of a client that's really utilizing the Next Best Product tool in an effective manner. Now, they've developed a matrix based on Next Best Product using that tool to go out in the second year of their relationship with a household. They start with an onboarding program in that first year and wanted to continue that momentum into the second year and did it with Next Best Product. We target those households based on the 15-month, 18-month, 20, and 24-month anniversaries and target those households specifically that have a Next Best Product of auto loan, checking, credit card, or personal loans. Now, they've been doing this for a couple years now, and you can see from those response rates they're having some great success using this. Good balances and a great ROI as well. I want to point out specifically to checking there. With this tool and this approach, they're able to bring in just under a 7% response in checking. Now, I don't know about you, but in my experience, your straight-up acquisition programs on checking, we're jumping up and down if we can get a 1 to 2% response rate. So when we're talking about a 7% response rate, we're talking about a really successful program. And Next Best Product has helped us get to that point. Well, as mentioned, a lot of our clients are using data that they have available to them to implement more of a trigger-based approach. Again, targeting households based on a specific event or situation going on with them. It creates a more relevant, compelling communication with them. Now, there are hundreds of triggers available out there, and I'm going to focus on 3 of them. And the first being the onboarding program. This, in my opinion, is one of the most important programs that you should have going on at your institution. If you're not doing anything else, you should be doing something with regard to onboarding. And a lot of institutions do a service-oriented onboarding where they're calling up, to make sure those new households feel welcome and making sure that they receive their debit card, don't have any questions on how to use home banking, that sort of thing. But a lot of them are lacking in terms of educating their new households on the benefits available to them through additional products and services at the institution. And that's really where you can have the greatest impact on increasing cross-sell and balances with a group of households. Because these households are so open to hearing from you in the first several months of their relationship with you, we continue to see success throughout the years on this type of trigger program. And you can see here from these numbers, we've got response rates. When we look across institution at an average response rate, we're looking at double-digit responses. We're increasing both cross-sell and balances quite significantly, and reducing that single product household rate. And that's looking at new households at the onset of the relationship over a 6-month period, what occurs there. All right, sorry about that. Okay, so the next trigger I want to talk about, kind of in the same vein as the onboarding program, but it's the ongoing account opening. And this has been something that's been pretty successful for our clients over the last couple of years. It's built off of the logic that recency of accounts opened is the greatest indicator of additional accounts opened. And what it does is it targets the non-new households that are opening products at the financial institution. And the primary push or offer here is a checking program for those that aren't doing checking. So this type of trigger will thank households for their new business and work to cross-sell that checking relationship with them. And oftentimes, in many cases, if the checking relationship already exists, it'll cross-sell an additional product. But as you can see here from these response rates, again, we're seeing just under a 6% response rate, which is great when you consider average response rates on checking acquisition programs. And then significant increase in cross-sell, almost 11%, and a 12.5% increase in checking penetration as a result of this type of trigger. Again, I think with the onboarding and new account opening programs alone, the impact that you can have in trying to gain that checking business and oftentimes that PFI status with a household you know, really can replace any straight-up acquisition checking program that you're doing today. The last trigger I want to talk about is the auto runoff, and this has been something, you know, Tony touched on this a little earlier as well, but it's traditionally been a very effective program for a lot of institutions that we've worked with, and it's been successful in retaining that auto loan business, and it goes out to those households who are approaching their runoff date. I think Tony mentioned targeting them in the 30th or 31st month, and that can vary from institution to institution. But, you know, the idea being that we're trying to retain that business, get in front of those households before they take their auto loan somewhere else. And, you know, the impact has been, you know, we've had a nice response rate as well as healthy loan balance growth for this. And indirectly, this program really impacts cross-sell by retaining that account relationship instead rather than losing it. We talked about there being a lot of different triggers out there, and you know, so these are just scratching the surface in terms of a couple of them, and some of them that we're seeing some real success with. But in addition to the triggers, you know, some other tools that have been really helpful in terms of increasing cross-sell or helping us define opportunity is external data. And I want to talk about two sources of external data in particular. First, we're going to talk about credit bureau data, and then we want to talk about bill pay information. In terms of credit bureau data, the information available through this provides a lot of insight into the opportunity you have available with your current household. From this data, we can understand who has loans elsewhere, what balance levels those are at, and oftentimes what monthly payments are. And the charts that you're looking at here are actually taking a look at a collective group of financial institutions that had this type of information appended, and to really assess opportunity. And what we found in looking at them was about 86% of loan balances held by current households were going elsewhere. And you can see the pie chart to the right there actually shows a breakdown of where those balances were coming from. The bulk coming from mortgage, not a surprise, but a significant representation by these other types of loans as well. So you can see definite opportunity just in looking at balances going elsewhere by current households. But in addition to that, we were able to identify the fact that 30% of customers on average had loan balances that they were bringing somewhere else. And the average loan balances that they were taking elsewhere was just over $94,000. Now that's pretty significant. And you know, while this is for a collective group of institutions, you know, performing this same analysis on your own institution is can be the real key to understanding what opportunity you have available. Now, if you're the average institution out there and you've got average retail loan balances around 10 or 15,000, maybe a little bit higher, maybe a little bit lower, you can see that you've got the ability to triple the business that you've got without even adding any new customers to that, just among your own customer base. You can experience that. So that's pretty powerful information and a great tool to be working with to try to increase cross-sell balances and profit in a very cost-efficient, effective way. I want to talk about bill pay, too, as a great source of information to help increase cross-sell and implement into a cross-sell strategy. Now, bill pay files can be a challenge to get, but if you can get them, it's full of rich information, again, telling us where some of your best households are taking their business. You know, they're paying their bills with their bill pay at their from their checking account, and they're paying another institution for that. So, you know, one of the things I want to point out with this kind of data is that, number one, you know, your bill pay users are your most engaged households. They're some of your best households. But not only are they some of your best households, they're some of the best industries households as well, because bill pay users use 26% more financial products than non-bill pay users. So if you can get more of their additional business, you're going to be well off. And from our internal analysis that we've done with some bill pay information, we found that 4.5, on average 4.5 loans were being paid through bill pay transactions per user per month. So again, some significant opportunity. And if you look at the breakdown of those loans being paid each month, you can see here that a good majority are paying different types of cards out there. But again, good representation from some of the installment and mortgage loans as well. So again, just significant information, good amount of data that you can arm yourself with. I mean, imagine if you had this type of information and went out to your engaged members, what you could do in terms of converting some of that business if you put forth that effort. The payoff could be tremendous. Tony?
Oops, sorry. So let's take a look here at execution in terms of the things that Christine talked about and then translating those down into the actual visuals. So here we go. We're going to talk through 3 campaigns. This is a small institution up in Minnesota. Now, they've looked at cross-selling opportunities on 10 different levels, and you're looking at 4 of their 10 executions. Now, interesting thing is with this, the cost of doing this campaign for an entire year for them was less than the cost of running print ads in 2 Sunday drops. So we're not talking about with any of this stuff spending hundreds or even tens of thousands of dollars. These are all small, micro, highly focused, targeted events. This particular campaign based on different types of next best product predictions. And over the course of a year, almost a 7% response rate, and for every dollar spent, $3 in profit. Next one, bill pay analysis. So you're looking at 3 of 20 different versions geared towards the product that we were trying to convert, geared towards life stage of the particular cycle group that we were talking to. And again, this institution is almost a $600 million institution, but we're not talking about tens of thousands. This is a quarterly campaign that goes out and it's under 2,000 letters a quarter. So again, not tons of money, focused, targeted, relevant and specific, $3 million in new balances, and for every dollar spent, $6 in profit. Next one is onboarding, and Christine made the plea for onboarding. If you're not doing it, do it. You will get a tremendous response, and you'll really go a long way to cross-selling and keeping those members, those customers engaged and not going single service. You're looking here, 3 of 8 versions, $13 million in new balances, and an 8.4% response just over the first quarter that this piece was out. So again, tremendous response. Now, last month, we talked about testing and the need for testing. And each month that we're together, I'm going to talk about testing. And I'm going to start to share some of the results that we have from our tests. This one here was the test of, does one respond to a piece of mail better with a postal stamp versus an indicia? And in the first test round, we found that yes, people that received a stamp on their mail responded with an average balance of a higher balance of 55% than those that got just the indicia. Now, that test alone doesn't mean a lot, so we're retesting. We're going to validate it in some different other events. But strategically, the point is this. Test your copy, test your offer, test your composition, test your frequency, test your color. Whatever you're doing, because you can measure the exact response to your tools, you need to be testing to prove objectively what works and what doesn't work. So that wraps our webinar up for cross-selling today. We'll make this available to you. If you have any comment or feedback, shoot them my way, and we'll adapt these to what you're looking for, in the coming months that we do these. We have 3 more to do for the balance of the year. Next month, as I said, we're going to talk new customer, new member acquisition. Then we're going to talk about, for 2012, 5 things you need to do. And then last, we'll wrap the year on the best of 2011 campaigns that absolutely had the most stellar results. So with that, thanks for your attendance and your time. I appreciate it. And everybody have a great day.